Welcome to the deep dive. Think of this as your personal shortcut to getting really well informed.
Yeah, we wade through all the complex stuff, the sources you probably don't have time for.
Exactly. And we pull out the core insights, all tailored for you.
We're not just, scratching the surface.
Sure.
We go deep. We connect the dots so you get a real understanding, and hopefully pretty quickly.
And this deep dive is especially for you, the learner. You're that curious person wanting to grasp things quickly, thoroughly, but without getting snowed under. We're hunting for those aha moments.
Right. And today, that hunt takes us into the, fascinating world of professional trading. We're using excerpts from Way of the Turtle, the secret methods that turned ordinary people into legendary traders.
Yes, the turtles. This book gives such a unique look at that experiment by Richard Dennis, the legendary commodities guy, the whole turtle program.
It really is unique. It's about his bet, basically, that he could just take ordinary people, novices, and actually teach them to be top traders.
Amazing. So the source itself, it's a blend, isn't it?
It is. It's got the personal story of Curtis Faith, who was one of the most successful turtles, but it also details the actual strategies, the rules they followed, and, crucially, the psychology, the mental game.
Okay, so our mission for you today, decode this turtle way. We want to pull out the most important, maybe surprising lessons from the book.
Yeah, give you a clear picture of what made this experiment tick and what the bigger lessons are about markets, about trading, maybe even about yourself.
Get ready for some insights. This could really shift how you think about things.
Okay, let's jump right in. The turtle experiment. It started with that bet you mentioned between Richard Dennis and William Eckhart. What was the core disagreement?
Well, it really boiled down to, is trading skills something you're born with, like an innate gift, or can it actually be taught, like a system, a set of rules?
And Dennis was firmly in the can-be-taught camp.
Absolutely. He was so convinced he put that famous ad in places like the Wall Street Journal, basically saying, I'll teach you, looking for trainees.
Seems kind of wild now, doesn't it? Just an open call, no experience necessary, learn from one of the best.
Totally. And the name Turtles, that came from a trip, right?
Yeah, the Singapore story.
Yeah.
Dennis and Eckhart were apparently visiting a turtle farm.
Right. And Dennis supposedly said something like, we're going to grow traders just like they grow turtles in Singapore. And it stuck.
A memorable origin, for sure. And Curtis Faith, the author, he answered that ad. His background was kind of interesting.
Yeah, he became hugely successful. Made, over $30 million for Dennis?
Something like that, yeah.
Yeah.
The book says over $31 million.
Wow. And Faith mentions he already had some confidence in systematic approaches before he joined, maybe from a math background?
Possibly. He felt that gave him a bit of an edge, maybe made him more open to just following the rules Dennis and Eckhart laid out.
Yeah.
That initial belief, it can be powerful.
Yeah, that trust in the system from the get-go. The book also paints a picture of Dennis himself, through his offices even.
Right, very utilitarian, no frills.
Exactly. Faith was struck by how basic they were. It kind of reflected Dennis's reputation frugal, focused purely on the trading, not the fancy surroundings. Performance over appearance.
And getting selected wasn't random. Dennis had this test.
The investment psychology inventory. And interviews, too. He was trying to figure out who had the right mental makeup for it.
Even back then, recognizing psychology was key. That's insightful in itself.
Definitely. He was thinking about trader traits before it was maybe as widely discussed.
Okay, so the turtles are recruited. What kind of world are they stepping into? Let's talk market players and risk.
Yeah, understanding who's in the market is fundamental. You've got hedgers, first off.
Like airlines locking in fuel prices. Southwest is the example Faith uses.
Exactly. They're not speculating for profit. They're managing risk inherent to their actual business. That's a key insight. Not everyone's trying to gamble.
Right. They want price stability. Then you have the speculators. That's the turtles.
Yep. Their goal is to profit from price changes. Buying low, selling high, or, short selling betting, the price goes down. They take on the risk the hedgers want to offload. And in doing so, they provide liquidity, right? Make it easier for everyone else to trade.
That's the theory. The book also mentions others briefly, scalpers, arbitragers.
Scalpers making tiny profits on the bid-ask spread.
And arbitragers exploiting tiny price differences across different exchanges. It's a whole ecosystem.
Definitely complex. And the main tool for the turtles was futures contracts. Can we break that down simply for you listening?
Sure. A futures contract is just a standard agreement to buy or sell something specific, a commodity, a currency, whatever, at a set price on a future date.
Standardized by the exchange.
Right. Quantity, quality, delivery dates all specified. And the book has that neat historical detail.
About the railroad cars.
Yeah. Contract sizes were sometimes based on how much grain or whatever fit in a single rail car. Makes it tangible.
That's cool. And prices don't move randomly. They move in set increments. The tick?
Correct. The minimum price fluctuation. Like for the British pound contract Faith mentions, there's a defined minimum tick size. Small moves, but they add up.
And where did this all happen? The trading pits. Faith's description is vivid.
Organized pandemonium, that's the phrase. He calls it a mecca for traders.
Yeah, this image of shouting, hand signals, constant motion, grains, meats, currencies flying around, intense pressure.
But underlying that apparent chaos, there's a process. Price discovery is happening.
Okay, so that's the mechanics. But the book really stresses the psychological side. Behavioral finance. This is critical.
Absolutely critical, because as Faith points out, markets aren't just cold, hard logic. They're made of people.
With all our hopes, fears, foibles, as he puts it, human weaknesses.
And those emotions aren't random noise. They have systematic, predictable effects on how markets behave. That's the core insight.
And that's where the opportunities can come from for disciplined traders.
Exactly. Behavioral finance people like Robert Shiller, Hirsch Sheffrin, they've studied how these emotions lead us away from pure rationality. Predictably irrational sometimes.
So what are some of the big biases the book flags? The ones that really trip traders up? For you, the learner, what should you watch out for?
Okay, several big ones. Loss aversion is huge. We feel the pain of a loss, like twice as intensely as the pleasure of an equal gain.
Yeah, that's well documented. Makes us overly cautious sometimes or take dumb risks to avoid locking in a loss.
Then there's the sunk cost effect.
Yeah.
Sticking with something bad just because you've already put time or money into it.
Oh, yeah. The book's example of the trader holding a losing stock just to avoid admitting that first $1,000 loss. Painfully relatable.
Right. Fear of admitting you're wrong makes the loss bigger. Very common. What else? Confirmation bias.
Looking for stuff that proves you right, ignoring anything that contradicts you.
Exactly. Like your friends holding that tanking IPO stock, only reading the positive news snippets. We filter reality to fit our beliefs. Dangerous in trading.
We all do it, though, don't we? And recency bias. That's about overweighting recent events.
Precisely. A few recent wins make you feel invincible, maybe take too much risk, or a few losses make you quit right before a big winner. Like you forget the longer-term picture.
And belief in the law of small numbers.
Drawing big conclusions from tiny amounts of data. Thinking 3 winning trades means your system is genius.
When it could just be luck.
It often is. And finally, outcome bias. Judging a decision purely by the result.
Right. A lucky win doesn't mean it was a smart trade. And a loss on a well-reasoned trade doesn't mean the reasoning was bad.
Exactly. You have to separate the process from the immediate outcome.
It's quite a minefield of mental traps. It's especially when money's involved. Okay, so knowing all this, the market players, the psychology, what strategies did the turtles actually use to find an edge?
Well, the book mentions various styles, but the turtles were taught one main approach. Yeah. Trend following. That was their bread and butter.
Trend following. Let's unpack that. What's the core idea?
Basically, you're trying to profit from the big, sustained price moves.
Yeah.
Trends that last weeks, months, maybe longer.
So you buy when things break out to new highs, suggesting an uptrend?
Or you sell short when they break down to new lows, signaling a downtrend, and then you ride that trend for as long as it continues.
You're betting that momentum will carry it further, entering at what might seem like expensive highs or cheap lows already.
That's the idea. Identify the big wave and ride it. But it comes with challenges.
Now, drawdowns, losing periods.
Big time. Trend following systems often have drawdowns, equity declines that can be pretty substantial, sometimes similar in size to the average annual returns.
Oh, so you need the stomach for that volatility.
Yeah.
And enough capital too, right?
Yeah, generally requires more capital because your stop losses, your exit points, if the trade goes bad, often need to be placed quite far from your entry.
To avoid getting knocked out by just normal market noise before the trend really takes hold?
Exactly. You needed to give the trade room to breathe, but still limit your maximum loss.
Makes sense. What about other strategies mentioned? Counter-trend trading. That sounds like the opposite.
It pretty much is. Counter-trend traders try to profit when markets aren't trending strongly. They might sell at new highs, betting the breakout will fail and the price will reverse.
Relying on support and resistance levels holding.
Heavily. Betting prices will bounce off those levels, not break through.
Okay. And swing trading and scalping.
Swing trading is like trend following, but shorter term. capturing moves over days or maybe a week.
Right.
Scalping is super short-term. Tiny profits on the bid-ask spread usually involves tons of trades, providing liquidity. And we mentioned arbitrage earlier, exploiting price differences.
So lots of ways to play the game. But for the turtles, it was about finding that consistent edge. What does that really mean in trading?
An edge is just a statistical advantage, something that means over many, many trades, you're likely to come out ahead.
Not winning every time.
Definitely not. But maybe your average winning trade is bigger than your average losing trade, or you win slightly more often. It gives you a positive expectancy over the long haul.
Like the house edge in a casino, but for the trader.
Sort of, yeah. But you have to find or build it yourself. The book mentions the E ratio, expectancy ratio, as one way they evaluated if their entry rules actually had this positive edge.
So how did they measure that?
Looking at things like, on average, how far did the price move in their favor after entry versus how far did it move against them? Comparing the MFE and MAE maximum favorable and adverse excursions.
Trying to quantify if the odds were tilted, however slightly, in their favor.
Precisely. And the Donchian trend system is a classic example they use.
Right, the breakout system. Buy when price hits a 20-day high, exit on a 10-day low, something like that.
Those were the basic parameters described. And they added filters, too, like using long-term moving averages, 350-day, 25-day, to make sure they were trading with a major underlying trend.
So filtering out trades that might be going against the bigger picture, trying to improve the odds further.
Yeah, the idea was that the filter improved the statistical edge of the basic breakout signal.
Okay, constantly refining, looking for that edge. And you mentioned support and resistance earlier. The book sees those as key areas where edges might appear.
Definitely. Support is like a price floor where buying tends to emerge. Resistance is a ceiling where selling pressure comes in.
And our biases help create these, like anchoring on recent highs or lows.
Exactly. Anchoring recency bias. These cognitive traps make certain price levels psychologically important to lots of traders. So you get battles there.
Buyers versus sellers fighting it out at those levels.
And the price usually won't stay there forever. It either bounces back or breaks through. That instability creates potential opportunities.
And you can use stops placed just beyond those levels to manage risk if you're wrong.
Precisely. If it breaks through your support or resistance level, the stop gets you out before the loss gets too big.
Now, a huge theme in the book is the long-term view. Not getting hung up on single trades. Good trading versus just being right.
That is absolutely fundamental. Successful trading isn't about nailing every call. It's about executing your plan consistently over time. Focus on the process, not the outcome of any one trade.
Distinguishing bad luck from bad trading. You can lose money even doing the right thing, system-wise.
Totally. A good system will still have losing streaks. The key is not letting those losses derail you from executing the plan properly next time.
And that recency bias, again, dwelling on the immediate past. That's poison, right?
It really is. The cocoa market example in the book is powerful.
17 losing trades in a row.
Yeah, 17 losers following the system, then it catches a massive winner. If you let those 17 losses shake your faith, if recency bias made you quit,
you'd miss the payoff the system was designed to capture eventually. Patience and discipline are critical.
Absolutely non-negotiable for this style of trading.
Yeah.
Which ties into understanding probabilities.
Right. Trading isn't about certainties. It's like insurance, the book says.
Good analogy. Insurers don't know which house will burn down, but they know the overall probability over many houses. Traders work with probabilities of price moves, not crystal balls.
And the pattern of returns isn't necessarily a nice, neat bell curve like, say, human height.
No. Trading returns often have fat tails, meaning extreme events, huge wins, huge losses happen more often than a standard normal distribution would suggest.
So you need to be prepared mentally and financially for those bigger swings both ways.
Exactly. Even a winning system will have good months and bad months, sometimes really good or really bad ones. It's all part of the probabilistic game.
And beginners focus on entry, but pros focus on the edge, the positive expectancy over the long haul.
That's a key distinction the book makes. Finding the perfect entry is less important than having a system that overall makes more than it loses across hundreds or thousands of trades.
Now, the book has that intriguing chapter title, The First $2 Million is the Toughest. Why is that initial success potentially so hard psychologically?
Well, imagine you start making real money, serious money. Then the market swings against you, and a big chunk of that profit evaporates, even if it's just temporary volatility.
The temptation to grab the profit or panic and get out must be huge.
It's immense. Faith tells that story about a heating oil trade. He held his position through a big dip, stuck to the system rules, while other turtles got scared and liquidated early.
And he ended up making a lot more because he followed the plan.
Exactly. It highlights the emotional strength required. Sticking to the rules when big money is swinging back and forth takes serious discipline. Psychological fortitude is just as vital as the strategy itself.
So what does it mean then to think like a turtle? What's the mindset?
It's about letting go of outcome bias, not judging yourself or your system based on one trade. It's about ignoring the past, fighting recency bias.
Playing your own game, not trying to predict or be right all the time.
Yes, and taking total responsibility. No blaming the market or your broker or bad luck. Your results are down to your execution of your plan.
It's a shift from trying to be a fortune teller to being a disciplined operator. And the edge comes from those market mistakes driven by others' biases.
Right. Support and resistance are examples of where those biases create exploitable patterns. But the book adds a dose of realism. Edges aren't guaranteed, and risks go beyond just normal drawdowns.
Yeah, past performance isn't future results, right? What other risks does it warn about?
Price shocks are a big one. Sudden, massive, unexpected moves. Faith mentions the 87 euro-dollar shock. He lost $11 million overnight, personally.
Ouch. Stuff that historical backtesting might not fully capture.
Exactly. And then there's system death. When a system that used to work just stops working, market dynamics change.
And it's hard to tell that apart from just a really bad drawdown.
Very difficult. Plus, trading styles go in and out of favor. Trend following has been declared dead many times, then it comes roaring back. It's cyclical.
So you can't just blindly trust history. How do you measure risk and reward then, realistically?
The book covers standard metrics: CAGR, max drawdown, MAR ratio, Sharpe ratio.
But it points out limitations, especially for trading systems versus, say, mutual funds.
Yeah, Sharpe ratio might not fully capture the tail risk, the potential for those big outlier losses in some trading strategies.
So what's better?
Faith emphasizes looking at the equity curve, visually the graph of your profits over time, and the distribution of monthly returns. Get a feel for the pattern, the volatility, the depth and frequency of losses. Don't rely on just one number.
Makes sense. See the whole picture. Which brings us to risk and money management. Staying in the game.
Survival is goal number one. A system with a positive edge only works if you're still around to trade it after the losing streaks.
Avoiding the risk of ruin. Blowing up your account.
Critical. The book warns against trading too aggressively, underestimating risk. Maybe aim for drawdowns you can actually handle, which might be half of what you think you can handle.
Be conservative. And money management isn't magic, right? It can't save a bad system.
No. It's about controlling exposure, improving your odds of survival. The turtles used volatility-adjusted position, sizing the N factor.
So risking roughly the same dollar amount per trade, regardless of whether it was volatile like oil or less volatile like a currency.
Kind of, yeah. Trying to equalize risk based on recent volatility. And they had unit limits, too. Capping total exposure, maybe filtering out markets that weren't performing well.
A systematic way to manage risk across the whole portfolio. Okay, what were the actual building blocks of these trend systems?
Things like breakouts, price moving beyond recent highs or lows, moving averages, smoothing price to see the trend, volatility channels like Bollinger Bands or ATR channels, creating dynamic bands around price.
And maybe simple time-based exits sometimes.
Yeah, getting out after a set number of days. The point is, there's no single magic bullet. Systems combine these blocks, and you have to tune the parameters like the look-back period for a moving average.
Breakouts were pretty central for the original turtles, though.
Very much so. That Danchin channel idea, break above the 20-day high, for instance, was a core entry signal. Bet on momentum continuing.
Now, the book talks about the myth of the expert. The danger of thinking there's some secret, complex knowledge needed.
Right. And the related danger of over-optimization, making your system incredibly complex and perfectly fitted to past data.
Which means it might fail miserably when the market changes slightly.
Exactly. Overfitting is a huge trap. The book argues that understanding your simple system and its limitations is way more valuable than applying some complex black box you don't fully grasp. Keep it understandable, know its boundaries.
Simplicity and understanding beat complexity without insight. The book then shows back tests of different systems.
Yeah, it compares 6 different trend systems: ATR breakout, Bollinger breakout, Donchian variations, moving average crossovers over a specific period, 1996 to mid-2006.
Showing the KIGR, drawdowns, MAR, sharp for each.
Allows you to see how different rule sets performed historically side by side. But it also shows how changing the end date slightly alters the results, highlighting the sensitivity.
Which leads straight into lies, damn lies, and back tests. Why might back tests be misleading?
Several reasons. Random luck in the historical data can make a mediocre system look great. The optimization paradox, tuning too much, makes it fit the past perfectly but predict the future poorly. Overfitting.
And trader effects, the act of trading influencing the market.
Yeah, if too many people start using the same signals, it can erode the edge. Like everyone trying to front-run the same large order Faith mentions.
The market adapts. So backtests need a huge grain of salt. How do you build more robust systems then? On solid ground.
Need enough data, enough trades, enough different market conditions, a representative sample. Use tougher robustness tests like RR% or R cubed that consider drawdown frequency length.
Not just max drawdown.
Right. And techniques like parameter scrambling testing, slightly different settings to see if performance holds up, rolling optimization windows, Monte Carlo analysis to see a range of possible outcomes.
Trade scrambling, too, to check for issues with sequential losses.
Exactly. Stress test the system from multiple angles. See if the edge persists under different conditions and assumptions.
Rigorous testing. And the book also champions diversity and simplicity for bulletproof systems.
Like biodiversity in nature. Market diversification, trading many uncorrelated markets. Currencies, commodities, bonds, stocks. Increases the odds something is trending favorably. Don't exclude markets too easily unless liquidity is truly an issue.
Right, like missing the coffee boom example.
And system diversification, running multiple different systems simultaneously. Smooths the ride, potentially captures different market behaviors. And again, simpler systems are often inherently more robust, less prone to overfitting.
Okay, finally, it circles back to psychology. Mastering your demons, this internal battle.
Yeah, the conflict between following your rules and your ego wanting to predict or be right. The ping-pong anecdote illustrates it well, pressure leading to mistakes, just like in trading.
And the don't be an ass story. Self-awareness is key.
Hugely. Knowing how your own emotions and behavior impact your trading. Ultimately, consistency and execution is everything.
Faith also mentions the X factor of being taught by Dennis that initial belief helped. But he knows managing bias is hard for most.
Right. He acknowledges individual differences and recommends others, like Van Tharp, Steenbarger, Ari Kiev, Mark Douglas, for more on trading psychology.
And these principles, they apply beyond just trend following, right?
Absolutely. The core ideas have a plan, know its limits, use the right tools, keep it simple, execute consistently, apply to almost any systematic approach in markets or even other fields involving risk and probability.
So, wrapping this deep dive on Way of the Turtle, what are the absolute must-remember insights for you, the learner?
Okay, number one, the power of a systematic approach. Having rules based on a statistical edge, not gut feeling. 2, psychology is huge. You have to understand and manage your biases.
Loss aversion, recency bias, all that stuff.
All of it. 3, understand risk and drawdowns are part of the game. Survival comes first. Plan for losses.
Don't trade too big.
Definitely not. And finally, consistency. Sticking to your plan, day in, day out, especially when it's hard emotionally. That's probably the single biggest key.
It really is a powerful framework, not just for trading, but like you said, any field with risk, uncertainty, long-term goals, those insights about behavior, market dynamics, they travel well.
They really do.
So we definitely encourage you, the learner, think about how these ideas might apply in your world. Maybe even pick up the book itself for the full story.
Yeah, it's worth it. And maybe a final thought to leave you with. In whatever you're pursuing, where things are uncertain, how do you find that balance? The balance between a solid plan, a good strategy, and dealing with the messy reality of human psychology, your own and everyone else's. It's like that Robert Frost poem, maybe taking the road of disciplined process rather than chasing predictions, is the one that truly makes the difference in the end.